Welcome to the Guide to Investing Part 2, where we look at asset classes. A unit trust fund is made up of different assets, namely equity, listed property, bonds, and cash. Equity. Equities, also known as stocks or shares, represent a share of ownership in a company that you can buy. If you have equity in a company, it means you own a portion of that company. The value of a company's equity rises and falls over time as reflected by the share price, producing gains or losses for shareholders. Companies may also pay dividends to shareholders, which represent a portion of the annual profit of the company. Equities are considered the most risky asset class because share prices are subject to large movements in the stock market on a daily basis, so the investor can experience large gains or losses. The risk decreases over time, however, so the longer you stay in equities, the lower your risk. Over time, equities have consistently produced the highest returns for investors. Listed property. You can own shares in property companies listed on the stock market, which gives investors exposure to various types of property, like industrial, office, commercial, and residential properties. Your investment returns are based on the company's fluctuating share price. Listed property also offers income in the form of regular profit distribution to shareholders, making it less risky than other equities. Bonds. A bond is a form of loan similar to an IOU. When you buy a bond, you are lending money to an entity, typically a government, a municipality, or corporation, and you get regular interest payments in return. Over time, you also get repaid your initial investment amount when the term of the bond ends. Generally, bonds are considered less risky than equities because they are less volatile. Money market. Money market instruments are essentially short-term loans which earn regular interest, usually with a repayment period of less than a year. They include certificates of deposit, bankers' assurances, promissory notes, and company commercial paper. Given their shorter term, the interest rate paid is usually lower than bonds. However, their risk is lower because of the shorter repayment period. What is diversification? Diversification means not putting all your eggs in one basket. The idea is to create a portfolio with a variety of assets to reduce risk. A fund consisting of a basket of different assets is also referred to as a multi-asset or balanced fund. Different assets produce different levels of risk and return. For example, blending equities with bonds in a portfolio can help reduce the overall risk of the portfolio. Since the values of these assets behave differently in different conditions, combining different asset classes in different proportions will help you achieve your investment objectives while taking less risk to do so. This is the basic principle behind asset allocation and one of the building blocks of a good investment strategy. For more information, feel free to contact our client service team on 0860 105 775 or email us at info@mng.co.za and one of our friendly investment consultants will gladly assist you. Alternatively, why not try the tools section of our website, www.mng.co.za, where we have a wide range of interactive investment aids to help you with your investment decisions. From saving towards your child's education, putting money aside for that something special, or checking if you are still on track for your dream retirement. Be sure to follow us on Facebook, Twitter, Instagram, and LinkedIn for more up-to-date insights about investing and to access our latest views on financial markets.